Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax-efficient or tax-free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no-cost, no-obligation consultation with me. Enjoy.
Good morning. Happy December, everybody. I guess we started this. Oh, let's see what was last. No, it was the 30th. So this is our first podcast. This is our first webinar. I've been listening to a lot of podcasts lately. My favorite one right now is called Talking Sopranos. So if you're a Sopranos fan, it's an interesting podcast. I'll say there's some things I don't necessarily care for about it, but it is an interesting podcast. But podcast is actually something we're going to be exploring for 2022. So these webinars, of course, have been fun, have been really great as far as communication with clients and just the general public out there. But podcasts can go hand in hand with this. What I have to figure out is, I do a lot of demonstration, as you know, with the whiteboard pretty much every week. And that doesn't translate well with podcasts. So it may have to be a separate event, but that's okay. So we're going to follow the same pattern we always do, and we're going to talk a bit about. We're going to have a slot update. I only have one update this week. There is some good information in the other updates from the Slott Group, but they had to do with very specific types of retirement plans, and really I didn't think would be a broad-based kind of interest. We're going to have some market updates. I have some really interesting. What I think are interesting reports from two analysts who are really on opposite sides of things. And I think that just really shows that you get competing ideas out there. And we'll talk a little bit again, as we always do, about how to manage that. And then we're going to talk about today for our financial planning topic, we're going to talk about diversification and capital gains. And this came about from a financial planning association discussion. So one of the things that I read on a daily basis really is the Financial Planning Association message boards. And I go through, and that really is always challenging me with different topics. And sometimes I answer questions for folks, but there's often good conversation about things that financial planners around really around the world, but certainly in the US are dealing with clients. So that's always good updates. So we're going to talk about today in our financial planning topic, we're going to talk about diversification, capital gains. Just want to remind you that you are muted. There's a Q&A section at the bottom of the screen there. You should see a little box that says Q&A. Please use that to tell me or any questions. Let me know what questions you have along the way. Your chat should be disabled. And of course, this is recorded. I always ask, could you raise your hand if you can hear and see me okay? Okay, everybody, thank you. Wonderful. Good to see everybody. We do have some things lined up already for 2022. We started scheduling our live classes. That's really still in flux. We're going to do anywhere from 4 to 6 live classes in the area. But we have David McKnight. I'm working on a webinar, certainly for David McKnight, end of January, early February. But very excited to say that it looks like we're going to be bringing David here live sometime in April. So I want to wait for the risk of snow to dissipate so we can all be there. We're of course looking for venue, things like that. But I had a conversation with David. He's excited to come out and see everybody. So that should be sometime in April. So that'll be fun. And of course, more events will come about throughout the year. I hope to have an open house with the new when the new office is open. Traditionally in the past, we've had a St. Patrick's Day celebration. So the reason for St. Patrick's Day really came because we used to be right on Sycamore Street in Newtown, and there was an Irish bar down the street that had this big, they closed off the street kind of event. We kind of piggybacked on that, and everybody most people have some kind of holiday event. And we were competing with, some people couldn't come. So we figured St. Patrick's Day is pretty safe. So we'll probably stay with something like that. So if we're able to, we'll have it around the St. Patrick's Day schedule, just if you want to keep your eye out for that. So let's talk about the one update we have for the slot report. And this is a really good one written by Sarah Brenner. So you probably have all recognized Sarah's name by now, but she's an attorney who works for the Slott Group as an analyst, and she writes about investing your IRAs in gold. Now, this is something that I hear from time to time. People say, well, I'd like to buy gold. And I saw on the internet, or sometimes you see them on CNBC, if you're following those channels or anything, where you buy gold in your IRA. And don't let anybody tell you any different. It's you use self-directed IRAs. We can help you set them up, and they make it sound very, very simple. Well, this was, of course, a tax court case called McNulty versus the commissioner. This is how it's set up. And it shows the risks of retirement savings if the rules are not carefully followed. This is the problem, is that, yes, things like gold, silver, other hard assets, real estate can be held in self-directed IRAs. There were very, very strict rules around them, and they can be violated very quickly, especially by just your average layperson who, sometimes thinks that he or she has an understanding of it, but often doesn't. I was talking to a prospective client. I might have shared this a few weeks ago, and he's obviously a very well-read person about IRAs and IRA distribution, but there are just a couple things that he had wrong and switched, and those little things could really affect things when you're talking about distributions. So Sarah writes, while gold and gold bullion are acceptable IRA assets or investments, there are strict rules that must be followed. An IRA owner who expects to hold gold coins in her hand, right? So she was holding, she didn't just she wanted to hold the precious metals. As suggested by some internet promotions, will be out of luck. The tax code makes it clear that if gold coins or bullion are held in an IRA, and this includes other precious metals, they must be in the custody of a qualified trustee or custodian. So the whole thing revolved around the fact that this person, McNulty, wanted to not just invest in gold and silver via an ETF or some kind of other traded investment. They wanted to invest in the hard assets. And in addition to that, they didn't want to keep that with a custodian. They wanted to keep it in their home, so they had it if they needed it. But they also wanted the protections, the tax deferral of it being an IRA. And that doesn't really work. So in the McNulty case, Mrs. McNulty set up a self-directed IRA with an LLC, a limited liability company, which bought gold and silver American Eagle coins. We've probably heard that, right? The silver and gold American Eagle coins. She kept the coins in her home, and that was a fatal error. The court found that a taxable distribution occurred when Mrs. McNulty took possession of the gold coins in her IRA. The entire investment was considered distributed and taxable. Her retirement savings, well, Sarah writes, her retirement savings were gone. Her retirement savings weren't really gone, but she was subject to the tax of a full distribution. Now, it doesn't say in here what the value of the McNulty assets were as far as the gold, but what if it were $1 million, and then suddenly, what if it was, or a couple $100,000, and suddenly that couple $100,000 had to be fully distributed all in 1 year. You have to pay tax on it. Plus, there's when you're talking about tax court, there's always pluses, right? So the court also hit McNulty with accuracy penalties. These penalties for underpayment of taxes can be avoided if a taxpayer acted with reasonable cause and in good faith. One way to do this is to seek professional advice. I always talk about, we don't get into these kind of what I think are sketchy, issues, but McNulty didn't hire a CPA to help her with this. That would have been very helpful to her. The CPA hopefully would have counseled her not to take possession of the assets, put them with a qualified custodian. That's one of the reasons you need your team. Listen, I think I know a lot about tax efficiency, tax planning, things like that. I'm consulting my personal accountant all the time. He is often giving me very good advice, certainly for my clients, but certainly for the things that I'm doing myself, and it's very, very valuable. So instead, the McNultys, instead of hiring a CPA, they looked to the website promoting the investment in gold. According to the court, this website was an advertisement of products and services and not professional advice. So McNulty said, but the website said that we could do this, and the tax court, of course, said that's not professional advice. That's just a sale of a good or service. The McNulty case is a good reminder that many of these advertisements you see about holding gold, or I see them about real estate, can be misleading. Many of them lead you to believe that you can keep your IRA gold at home, maybe with the help of an LLC. This is a fatal mistake. If you take possession of the gold in your IRA, it's a taxable event. When she's saying gold, any tangible asset like that, your savings are gone. Again, big portion of it could be gone from the tax. The case also shows how free internet research can end up costing you a lot. Boy, isn't that true? Relying on information on a website can be a mistake because the IRS does not see this as seeking professional advice. Independent advice is critical, especially when it comes to, she says, alternative investments like gold, but she's just about everything. So I have a woman who's been working with me for a long time, since I was at Wachovia, and she came to me as a widow early on. I had a bunch of widows at the time for some reason, and many are still with me. But we had a discussion several weeks ago, and it was around her estate planning. And she said she talked to a friend of hers who attended a seminar who told her that she needs to put everything in her will, and so because the will is the only way to avoid probate. Now, wills are made to go through probate. That's the reason for the will. So she clearly heard a little bit of information. Maybe her friend got it twisted around. Maybe she got it twisted around. So she was very, very assertive about this. And she said, well, I'll have to call my friend back and tell her that you say it's different. I said, well, tell your friend that your certified financial planner who specializes in things like estate planning says that, she should check her advice. And I strongly suggest that you don't do something like that with all the planning we've been doing. So be careful. Many people get financial and other advice from their uncle, brother, cousin, plumber, friend. I greatly respect the people who specialize in what they do, but they shouldn't veer out from that specialty when they're advising others. So I hope that all makes sense. Really, really good point, because I do hear this a lot. So it's interesting at the beginning when so as we're coming, this is always a time of reflection at the end of the year. And as we're coming up on the end of the year, I talk about, or I look at some of the notes I've had in here. In the beginning of the year, I wrote plan for a rocky 2021. And it's been a rocky 2021. We had a lot of great upside, and then we've had volatility over the past few weeks. But it certainly has had its moments. So, I guess you could honestly say that about any year, but I'm just reflecting back on some of my notes. So let's talk about the markets last week. Last week, the markets, the Dow Jones Industrial Average and all the stock market indices across the globe were down, except for the emerging markets index, which was up 0.2%, very small. That index itself, the MSCI Emerging Markets EM, is down for the year 3.18%. Dow Jones Industrial Average was down last week, so just under 1%, 0.76. The S&P 500 was down just over 1%, 1.18. NASDAQ was down over 2%, 2.6. All these are still up for the year and up handily year over year, right? Because we're getting really close to there. So what year to date for the Dow Jones Industrial Average is 15.05, still a great return. Is it lower than it was a few weeks ago, a month ago? Of course. The S&P 500 is still up 22.43% for the year. That's a great year, no matter how you shake it. I just hope that we end the year where we are. The NASDAQ is still up 17.79% for the year. And the rest of the world, right, the MSCI World Index, not including the US, is up 8.32. So across the board, really, really good. The bonds are down. We know that the aggregate bond index is still down just about 1%. The 1 to 3 year bonds are down 0.42. High yields and munis and high yield munis are still up. So there is some areas that have done well in bond markets, but as I've said, the bond markets are the trickiest markets right now. 10-year Treasury came down a little bit to 1.34 over the past year. Over the prior week. The prior week was 1.47. This time last year was 0.91%. Crazy. So that's just a snapshot of the markets. Now let's talk about what these analysts are talking about. So I'm going to talk about two in particular, and one is Riverfront. So I've told you about these guys before. These guys are based in Virginia. they were a group of individuals who I worked with at Wachovia, who ran some of the investments at Wachovia. When Wachovia was based in Richmond, Virginia, it was a really neat, felt like a small, I know Wachovia was a large, national institution, but it felt small. And I can't say enough about how much I enjoyed my time at Wachovia. We had a great group of individuals who worked together locally in the Bucks County, even greater Philadelphia area. The investment platform was very what we call open architecture, where there weren't many limitations of what we could invest in. I was investing folks in Vanguard funds and Fidelity funds, and I've always been a fan of Vanguard. So, and that's not an endorsement of that, or I should say it's not a recommendation, because there's some funds that are good, some funds that aren't within Vanguard. But I've always generally been a fan of Vanguard. But Wachovia didn't have limitations on that. Wells Fargo was a completely different story when they came over, but came in. But this group of individuals who left Wachovia about a couple months before I did, just before Wells Fargo took over, they started this company, Riverfront. They're still based in Virginia. So the fellow who writes this piece, Rod Smith, I'll never forget he was presenting to a group of us in Virginia, and he was showing the dot-com bubble and overlaid it to the housing bubble. And this was before the bubble broke. This was before 2007, 2008. And he warned us, it's right around the corner. This is very similar. It looks like it's going to happen. He's very much a technical analyst, but so I do have a lot of respect for their investment research, Riverfront. I don't use their management platforms. I look at them about once a year. They don't meet our needs. They just don't perform the way I would like them to perform. I would love to find a third-party manager who I can put my faith and trust in, and have an appropriate cost along with it. But I've yet to find that group other than Vanguard. So anyway, so here are the key takeaways from this. So I'm actually just going to read you the paragraph here. So Rod writes, despite a devastating worldwide pandemic that caused the worst global recession since the Great Depression, we know that, the stock market has had a remarkable past 3 years. They say, in our view, right, to just make it easier, I guess, for compliance. While we believe the pace of the market's advance is not sustainable over the next 12 months, so I was just reporting to you, what would I say, 14%? See, it's escaped me already, but I got to run back up and see. Let's hear. 15% for the Dow Jones Industrial Average, 22% for the S&P 500, and it was, we had strong returns last year too. So Rod Smith from Riverfront says, we believe the pace of the market's advance is not sustainable over the next 2 months, so we're expecting it to calm down a bit. We think such strong momentum is a bullish indicator. So they're saying that it'll still continue to be good, but not as strong. I mean, I don't think any analyst, well, I'm sure there's someone out there, but I don't think any reasonable analyst will say, let's just expect another 15 to 22% return, because they're likely to disappoint people. So, so they're saying over the next 12 months, they think the momentum is still strong, reflect on the magnitude of the rebound in the economy and earnings. But in this, here, Rod talks about the emergence of the new COVID-19 Omicron variant and our views on simplification of the market and for investors. Now, this is really interesting, because I want you to compare what another analyst says. So the key takeaways are this: the market's rise has been justified by strong fundamentals, right? So that's basically saying that companies, they have strong balance sheets, they're doing well, the sales are there, so that's what's driving it. We expect continued growth in earnings and remain bullish on stocks. Bullish means that they expect stocks continue to grow. We believe investors should prepare themselves for the inevitable corrections that will come. So they're hedging a little bit, saying that at some point they're going to see corrections. Of course, it's almost math that we're going to see corrections from time to time. We saw it just a month ago, or we may still be in it now, but things happen as far as corrections. And here's a little bit more detailed. So the last 3 years, he writes, have been truly remarkable for all of us. Here's what it's meant for U.S. stocks, just United States stocks. The S&P 500 has risen 81% since January 2019. delivering gains of 29%, 16%, and 21% year to date. We just talked about that in each of the last 3 years. So 29%, 16%, and 21%. And the 16% and 21% during a global pandemic, 16% during a global recession. And I would still say that we're still struggling with recession. In the last year alone, it rose over for the S&P 500 rose over 40% from its low last October to the recent highs. He talks about moving day average. All this occurred despite a devastating worldwide pandemic that caused the worst global recession since the Great Depression, and continues with the new Omicron variant. All right, so what he goes on to say, while we believe the pace of the market's advance is not sustainable over the next 12 months, we think this is what I just read above. So they think that some growth will continue. Now he goes on to talk about the emergence of Omicron. This is important. It's been depressing to learn of another variant of COVID-19. No one can know what the impact of further strains will be, hence the global stock market sell-off. That is what we've seen over the past few weeks. But what we do know is this: the drug industry has been very innovative with producing vaccines and new antivirals with plans for tackling this variant. Pfizer and BioNTech recently announced that their joint mRNA vaccine against COVID-19 could be tweaked within 100 days, specifically to counter Omicron. So I'm not going to get in a discussion about the effectiveness or efficiency or efficacy of vaccines with anyone, but this is the general information out there. Americans have largely decided whether they want to get vaccinated or not. Very true. The lines have kind of been drawn. Thus, the spending habits of the last 6 to 9 months seem unlikely to change materially. I thought that was an interesting point. We understand who's in, who's out. We can track the spending habits, and we can track how people are responding to this. I think that's a very good point. Despite the arrival of the more contagious Delta variant, the S&P 500, remember when that was? The S&P 500 continued to rise with only limited setbacks. We do not think the reaction to Omicron will be significantly different. So another great point: should this variant have more serious economic effects, we expect Fed policy to become more accommodative again. So he is saying that if this variant really starts packing a punch, that we expect, and I agree, that the government will again step in to help normalize things. The importance of risk management and mental preparation. Sustain and distribute investors tend to own more stocks these days due to very low yields on bonds. Great point. Bonds are paying bupkis. More people are getting into stocks to help take that dividend yield, help generate some growth. So that means they're taking additional risk to help get those returns. This leads to more volatility and potential bigger drawdowns in their portfolio. So remember, when stocks are down, when you invest more in stocks than you normally would because bonds stink, and then the stock market falls and you have to take money out of your portfolio while the market is down, that can be devastating. So bigger drawdowns on portfolios, because if you're down 10%, you have to take 5% out to spend, you're drawing 15%. That's a big hole to climb out of. As discussed earlier, we do not anticipate another significant bear market as occurred in 2020. At that time, COVID-19 was a complete surprise, whereas now it is dealing with a large unknown entity and has developed tools to help mitigate the consequences. So that's interesting. We can see a big drop at any given time. You know, we've got a lot of crazy stuff going on in the world, so we can see a big drop. I appreciate their optimism there, but generally an optimistic article about Omicron, about the markets going into 2022. You know, they're not going to push us into later years at all. You know, again, these are investment managers, not financial planners. We have different roles, right? Now let's look at the other side of this. So, you know, another fella I like to read and I like to report on is Robert DiLucia. He's the economist from Prudential. Well, he's on the completely other side of this. So financial market volatility has increased markedly in recent days, evident in massive price swings in the equity, bond, commodity, and foreign exchange. So he talks about the VIX, which is a measure of volatility. That went from 15 to 35. That's a big, uses the word surge to 35. The U.S. Treasury market has declined. he talks about the modest 3.5% decline in the S&P 500 index from its all-time peak is misleading and does not provide an adequate measure of the full extent of the equities or stocks market weakness. Fully 1/3 of stocks, this is bold and italicized in his report. Fully 1/3 of stocks within the index have suffered a decline of 15% or greater in recent weeks. He goes on to talk about defensive stocks with largest market capitalizations: Microsoft, Apple, Alphabet, which is Google, Home Depot, PepsiCo, and Procter & Gamble have bolstered the index, have helped hold it up, while the less stable small companies has declined by nearly 12%. So he's saying we've got some companies holding up the index, so it's making it that it's only dropped 3.5%, but some individual companies gotten hit much harder. So we're probably going to see that in some mutual funds, some actively managed mutual funds that compare to the S&P 500, where if they have big positions in some of these things that have been high flyers at their ship, because remember, mutual funds are typically not passive. They actively trade in and out of stocks. So they've taken big positions in some of the, Microsoft, Apple, Google things, some of the things we've talked about. And these, they would have been more stable that way if they would have taken big positions in some smaller companies and looking for some growth specifically. Then we could see a drawdown significantly greater, right? A return that's significantly more volatile, right? Losing more money than, say, the S&P 500. So I mixed that up a little bit. I'm sorry for that, but I hope I brought that around okay. So tell me if you need clarity on that. So he goes on to talk about weakness in other areas of the domestic equity market. He's very technical, so I'm trying not to give you the technical jargon here. But he talks about the FANG, the index, which plummeted nearly 8% in only 3 days. In principle, financial market volatility tends to increase in response to external shocks that alter previously held investor perceptions regarding the direction of the economy. No, that's true. Let's see. Financial market stability is characteristic of a condition whereby economic and policy trends are relatively constant, and there is a broad consensus regarding the outlook. In identification of the Omicron variant to COVID-19 shocked financial markets and raises a specter of resumed restrictions to mobility and commerce, along with lingering supply chain disruptions. He talks about the conduct of the monetary policy is also a big unknown. Investor anxiety regarding COVID-19 has increased, he says, first because of the Delta variant, now the Omicron variant. So he goes on and paints this very negative picture about the Omicron variant, the pandemic, the supply chain, the Federal Reserve, which is much different than what we just read, right, from Riverfront. He goes on to say outlook for monetary policy remains unclear. The outlook for the fixed income market remains grim. Their bonds, the stock market will continue to be driven by expectations regarding inflation, monetary policy, bond yields, and corporate earnings. So DeLucia is not as rosy as Rod Smith from Riverfront. So I thought this was really good. And I read these back to back, and I thought, wow, this is a good example of some of the things that we're dealing with from an investment point of view. Because who do you believe? Well, first thing is one of these guys is going to be dead on, but potentially, but probably it's going to be somewhere in the middle. So what do you do with this information? Well, you pay attention to it, and you hear all opinions, and that's something that we should do more of in this country, right? Is hear more opinions, all different opinions. But then you make your decisions based on what your needs and goals are. So they're talking about 2022. We have to look well beyond 2022. So I have to go back to the fundamentals. The fundamentals are asset allocation, making sure you have a good mix of stocks, bonds, cash, all the different investments. You have precious metals in there, real estate. So proper asset allocation driven by good companies and driven by what your needs are. Like good, when I say good companies, I'm talking about good investment companies. And then principal protection. You want a portion of your money that's protected if DeLucia is right. What if we have significantly continued drops in the market? Well, BlackRock did a really, really great study. I'm still looking for something I can share with you with the public that showed if you take about a third of your money and you put it in something that's principal protected, that helps significantly hedge the risk of increased drawdown of your portfolio. It'll make your money last longer and you'll have more money to spend during your lifetime or pass on to your kids, basically. But even in modest markets, it helps grow modest markets. So having that principal protection is very, very important. And then, of course, account segmentation. Account segmentation says that for each stage of your life, for the next 35 years or however long it is that you're in retirement or preparing for retirement, you have an asset allocation. You have a bucket of money there, or a segmented portion of money that's going to fund that period of time. So we can speculate. We can not really speculate, but we can kind of see what happens with who's right in this. And we can be invest more aggressively on the longer end, but more conservatively on the shorter end to help fund what we need. So it's again, I always say it's very simple, but not easy, but that gives you that foundation and you want that foundation to work off of. So I hope that makes sense. All right. So any questions about anything there? Have a question? Gerard, what is the market position should economic or military actions happen in China, Taiwan, and Ukraine? So I'm not going to make any market predictions. I'll just say that anytime there's military action around the globe that threatens, certainly general global economy, trade, we're going to see shocks in the market. The long-term effect is really the question. So you've got, this goes back to my point where you've got to be prepared for shocks in the market, and shocks could last a few months like they did during the COVID downturn. It could last a year and a half like they did during the global recession. So you've got to be prepared for both. Great question, Joe. All right. Now let's talk about, I'm going to share my screen. Let's talk about the financial planning topic. And we're going to talk about diversification and capital gains. So again, this came about during my readings from the Financial Planning Association. So I'm preparing to pull my screen in. I'm going to look down like I always do, so I can draw on this. So this came about from this readings on financial planning, and I'll just give you some background here. So the person had said, I have a client who has in their taxable, just remember our buckets here. We have taxable, tax deferred, tax free, or tax advantage, however you want to say it. So here today we're going to focus on this bucket here, taxable, because remember, tax deferred are your IRAs, traditional, right? Traditional IRAs, 401ks, it can be annuities. It depends. Annuities can kind of straddle those too. So anything where you're promising that you'll pay the tax later, right? You either got a deduction going in or you didn't pay the tax. Anything tax-free is anything Roth, and some properly structured cash value of life insurance. Some people call them life insurance retirement plans, but they're the only two things that are truly tax-free. Taxable, this is where your funds sit that have anything that's going to produce capital gains. And this is what we're going to talk about today. And there's long-term gains and short-term gains. Today, we're going to focus on long-term gains. Short-term gains are taxed as ordinary income, just like you earn it. So we're going to, let me undo that because it's going to get confusing. Today, we're just focused on long-term gains because they're taxed differently currently. You also get tax on dividends, interest, etc., coming out of this taxable bucket. Well, in the case of the person who was talking today, who was writing questions to the Financial Planning Association world, I think I remember this right, but it doesn't really matter. They had about $1.5 million here. They only had about $300,000 here. And as far as I know, they had about nothing in this tax-free. So they said, here's my concern. The majority of this $1.5 million consisted of Apple and Microsoft. And he said, clearly, we have probably too much risk in this portfolio. I say probably, because it all depends on what they need, right? This is where it gets very individualized, because if they have some of these folks that work at pharmaceutical companies around us here in Bucks County, Pennsylvania, New Jersey, They have large pensions. I have a fellow who's got about $150,000 a year in pension. So if this, and then you add $40,000 of Social Security, well, that's about $190,000 pre-tax. That might be enough for people, and this might not really matter. But let's assume it matters, and this financial planner says, well, clearly we have to diversify this, right? Let's make it a little bit bigger. We've got Apple, and we have Microsoft, and then we have other funds in here. This should go the other way around, right? We should have broad diversification, asset allocation, and he's right from one point of view, and this should be rebalanced and all that. Now, what he's saying though is that if $1.3 million makes up Apple and Microsoft, and he's got a basis, so what they paid for this is $200,000, just to make it simple. Well, if he sells this all in 1 year to achieve diversification, then he would owe tax, right, on $1.1 million. And no matter how you slice it, that's a big one. That's a lot. So what's the case for diversification? The case for diversification first is, well, what if this doesn't exist? What if this doesn't exist? There's no pension, and there's only $40,000 in Social Security, and this person needs to spend $80,000 a year, for an example. Well, in fact, then this person's going to have to draw income from here, right? Income's going to come out of here. They don't have anything here. And they're going to have to draw income out of here. And knowing that the majority of this is Apple and Microsoft, let's bring it down here. The risk, of course, is this could be, I'm just going to make it simple. These aren't the real numbers. Plus 20%, plus 20% minus 20% any given one in any one given year. So if they have to take, $50,000 a year out of this, let's just say, and the markets are down, and these two positions are down significantly. And in fact, couldn't they be down more? They sure could. Just math alone says that they could be down 40%. But if they have to draw $50,000 a year out of it, then they're drawing down $50,000 when the market's already down. And then, so what happens is, here's, if you just look at this as one of these charts here, and let's just say you draw it here, right? So here's, it grew from 200,000 to 1.5 million. And you have to draw it out here when it's down, and it's down 20%. And now you have to take another plus 50,000 out of that. So now that deepens this hole for you. Your personal hole is a little deeper because you're never going to make this 50,000 up. So you got to draw out of there. So not good asset management. So the case for diversification is, well, if we take this and we move it to an asset allocated position, we're gonna dampen this. We're gonna reduce this fluctuation. They won't likely earn more, but maybe it's plus 10, minus 10, so that this hole won't be so deep when you have to draw money out, because it gets compounded every year, right? So if you're taking money out every year and you continue to be down or sideways, then the hole just gets deeper. So the case for diversification is, okay, it makes sense. It's reduced the risk, and therefore you're likely to be in a better position. So that's valid. The cost of that, of course, is 1.1. Is that what I said? 1.1 million times, and I'll tell you how we get this in a second, but it's going to be roughly, it's not going to be this clean, but 20% tax plus 3.8% surcharge on that tax. So most of that will be at 23.8%. Oops, it's a lot of money. No matter how you shake it, it's about $250,000 in tax. So the question is that worth it? So really great question for anybody in this position. There are a lot of people in this position. Now, how about so that's the case for diversification, right? Reduce the risk. So we covered that. How about the case for the holding? Well, the case for holding it is, well, we do have other funds available. We don't know how old this person is, but let's say they're 65 years old. And we do have other funds available, even a modest amount, 300,000. But what if, let's go back to the buckets. So taxable, tax deferred, tax free, what if, forget about, you all know me, I would be talking about converting this to Roth. And so it's tax-free over here, but let's just say that's not an option. I think it would be, but whatever. And $1.5 million over here, still an Apple, Apple and Microsoft mostly. Well, we could look at it this way. Well, if we know that, assuming it's $50,000 a year, this person needs to draw. In bad years, when Microsoft is down and Apple is down, right? Because it will happen. They've had, and the argument from an investment management point of view is somebody, let me make sure. Hold on, Jack. I'll see if I can get back to you on that. So I'm assuming everybody can see my screen. I didn't check in on that. Everybody raise your hand if you can see my screen. Okay. Sorry about that. Okay. Thank you. So, in negative years here, when if you have, or when you have time, because it really is when, right? Apple and Microsoft have done very, very well over the past several years. So when these go down, couldn't you draw the money out of here? You can reinvest. So you can take, let's say this whole $300,000 was also in Microsoft and Apple. Do people invest that way? You're darn right they do. They keep the same investments here as they do in here sometimes. Well, you could reallocate this easily, right? You can make this your allocated portfolio. And there's no tax consequences there because it's all tax deferred. So better, of course, if it ends up here, but again, I won't go there. So in years when these markets are down, right, these positions are down, well, sure, you can take money out of here. You can take the $50,000 directly out of your IRA. Of course, you're going to pay ordinary income tax on it, but you're paying ordinary income tax on just the $50,000, not capital gains on $1.1 million to stabilize the portfolio. So that's the first place that you'd look. And that's a little bit of segmentation, right? Segmentation says, you've got a portion for each bit of it, but you're identifying where the money should come from. Now, in good years, nothing wrong with the money coming from this side here, right? You take the money out of here, you save it. And really, if you think about it, even if the worst drawdown we had was the Great Recession, right? So that was October 2007 until March 2009. Now, it could be worse than that, of course. But in that case, looking back, you could take some withdrawals out of here and still be sustainable, right? 50,000, 50,000, 50,000. These probably increase a little bit every year because your inflation needs go up. But that is a case for hold. The other case for hold is, well, what if we identify that, so that one is draw from other accounts. Now, listen, if this fella had come to us 5-6 years ago, what would have happened. First of all this $300,000 would be sitting over here in Roth. He wouldn't be paying any tax on that. So he'd have a lot of shot. We would have started swinging this money over into a life insurance retirement plan or a cash value life insurance if they qualified for it. And they could have taken distributions out of here, who knows, maybe $25,000, $30,000. That is also zero tax. So you want, and you folks who are clients of ours know it, you want levers to pull from in different times. And that includes that principal protected section. Pull out of here, pull out of here, pull out of here, and determine where that money's coming from as the needs, your needs and market needs or issues arise. So that is a case for holding. Second, so one is draw down from other accounts. Two, sorry, we're going to go over a little bit here. Two is you got to determine what you need this money for. Again, if they can live off of a smaller amount of money, we might determine that a large portion of this Apple and Microsoft ends up in their legacy longevity section. So if you're clients of ours, you know exactly what that is. There's many of you, we determine that there's an amount of money that you're probably not going to need. And if you're going to pass this money to heirs, right, kids, other relatives, we currently have a step up in basis, right? Step up, it's technically a step 2, but most people refer to it as step up in basis. That means if, God forbid, you pass away, or when you pass away, that $1.5 million gets a date of death valuation. And if that were today, 12/7, if this poor fellow passed away today, 2021, then his heirs, their new cost basis would be $1.5 million, not $200,000. So he would have needlessly paid that tax if it was determined that he wasn't going to need that money during his lifetime. So that's the second reason for hold. You don't determine these things without financial planning, by the way, right? Of course, you've got to do in-depth, comprehensive financial planning. That's why it's so important. You all know that we shake every tree on this. And this is why, because these are real life examples. 3, we have gifting, right? You can gift this money over your lifetime. There's also something called an exchange fund, not an exchange traded fund, but companies have these things called exchange funds where they can take a $1.5 million portfolio with concentrated positions and create a fund that is allocated, and there's no capital gains to that. So they're complex, but they can be done. Let's see. Charitable. We talked about charity. No, charitable trusts. So if you have charitable inclinations, these can be set up in charitable trusts where you can gift the money, future gift, and you can draw income off of it. So that'll help avoid capital gains. And you may, if you're on a path, if they were on a path to, we're going to talk about capital gains tax in a second. If they converted this money to this 300,000 to Roth, as I suggested, this is all based, your capital gains, other taxes, all based on capital income. So if we are able to, or taxable income, if we're able to reduce their taxable income, we could have a 0% capital gains rate after Roth conversions and tax efficient planning. So what does that mean? I may have piqued your interest there. So let's make sure I'm not missing anything here. Go back to the beginning. Sorry. So that's a case for holds. All right, now let's talk about capital gains and capital gains tax. So yeah, we're going to go quite over here. So we know the marginal tax brackets 10, 12, 22, 24, 32, 35, and 37. That's where they stand today. And we know for married couples, they go like this. So from $0 to 19,900 is 10%. From 10% to 12% is, of course, 1901, 19,901 to 8150. And the 22 is 172, 750. And then the top of the 24 is 329, 850. Now that's for married filing joint. For single filers, we go here, 0, 9. Why don't I do this before the webinar? Because it's not as much fun. 40,000, 525. The top of the 22 is 86,000. And remember, this is a good example because you married couples out there that are not that are slowing down your Roth conversions. You're considering slowing them down because you're afraid to pay tax. Look at the big drop between married and single income rates and how fast you move up the schedule here. That doesn't stop here. I'm stopping here, right? But of course, these tax rates go up significantly. You can see this on my website. I've shown you where that is before, 164, 925. All right, so that's how income works, right? So capital gains is like this. It's a little simpler. 0%, 15% with an asterisk, and 20% with an asterisk. So from 0% for married filing joint couple, you're at 0 to $80,800. You pay 0. All right. So that's based on modified adjusted gross income. 15% is from 80,801 to 501,600. And then anything over 501,600, of course, is at 20%. And that's for married filing joint. And here for single, we're looking at 40,400 and 40,401 to 445,850. Now, what are these asterisks? And anything above that is in 20. What are these asterisks? So in with the what do you call it now? The Obamacare, the Affordable Care Act. There's a Medicare surtax. So anything over these, or anything over $250,000 of modified adjusted gross income. For joint filers, for married filing joint, there is a 3.8% surtax, and that is $200,000 over modified adjusted gross income for single filers. Okay, so so why do I say this? Because there are two different tax rates, right? This is income, and these are capital gains. And this is only long-term capital gains. So if you don't have any taxable income above 40,400 or 80,800 for a married couple or a single person, you could pay 0% capital gains. So why did I take all the time to do that? Because you know that many of us, after we do the effective tax planning, we go back to the buckets and we take the money that's in this these tax deferred buckets. These are taxable, tax free. We convert these to Roth IRAs. We keep an amount in here if you can that is below standard, that creates an RMD that's below a standard deduction. Anything that comes out of here, we don't pay tax on, right? That's not taxable income. If we take part of this $1.5 million in that example that I showed you, and over time move that, if you're able to a cash value life insurance or a life insurance retirement plan, do we have to move the whole thing over? You know, do we have to do $150,000 over 10 years? It's probably not likely. Because if we have it, and of course it's a balance. If we figure out how much is going to go into here, and maybe it's, you know, $25,000 a year for, well, it might be more than that. Let's say $100,000 a year for 7 years as an example. And this builds up over time. And now you have, let's call it $800,000 worth of cash value. You're going to have a death benefit. You may also have a long-term care benefit. But any money you take out of here for your retirement income is also not taxed. So if this isn't taxed, right, your required minimum distribution, or you got nothing coming out of here that's taxed, and if this isn't taxed, and this isn't taxed, and you can reduce or eliminate your Social Security tax, but you stay below that $80,000, $800 threshold, or $40,400 threshold for single. Your capital gains then would also be zero tax. So you've got to think ahead of that, because if we just focus on asset allocation, well, it makes sense, like this planner wrote, it makes sense to move these funds out of from an investment point of view, but how about we're missing the tax point of view? Because if we shift the retirement assets, if we're able to shift these assets, could we potentially get to a low enough amount where we can start taking money out of here? Be very careful, working with your CPA, working with your planner, to be below these thresholds where you're paying 0% capital gains. And if you determine that, hey, I may not be willing to put $1.5 million into legacy longevity, or my plan doesn't allow that, or I want to spend more money, but we move $700,000 over here, and that leaves us, what, $800,000. I think that math works. $800,000 over, there's a $50,000 difference there, but just approximately $800,000 there that you can draw off of over time. Well, we could start peeling it off and stay below this and also have a zero capital gains rate. Now, again, big switch when someone passes and it suddenly goes to single filer, right? Because that gets cut in half. That's half, right? Divided by 2. It's really simple. So that's a technique. That's a strategy. Of course, it's complex, but these are really, you know, these planners on this message board, nobody talked about this. And I find that intriguing, because they're all talking about, well, it's likely that Apple and Microsoft aren't going to continue the climb that they've done, and they're going to level off. And that's all that is very true. So there's good reasons to diversify. There's good reasons to also hold. But it has to be explored. Can these funds get out of here on a tax-free basis? And you have 6 different ways that can be done, right? So I showed them to you there. 6 different techniques. So I hope that was helpful. I know we have some questions. Let's see here. Do long-term capital gains and long-term capital gains and short-term capital gains get factored into IRMA? Yes. So IRMA is based on modified adjusted gross income. If you move money from taxable to cash value life insurance, LIP, RP, don't you pay income tax on the money you moved? Roseanne, you would pay capital gains tax on the money you moved, yes. But what I'm saying is you do it on a schedule, just like you do schedule for your Roth conversions. You do it piecemeal, and you can manage going back to this bracket here. You manage it. Maybe while you're funding your life insurance, you're not able to stay below 80,000 if you're married. I would argue that that's a pretty strong amount, but you could probably stay below 500,000, and you could probably stay below maybe $250,000. So there might be a real opportunity to start bringing that money over. Remember, in very few cases do you just flip a switch and say, I'm going to convert all this to Roth IRA, or I'm going to move all this out of my taxable account to something different. So the initial question was, does it make sense to move it for diversification? And I would say there's probably other ways to do that. But of course, that also goes back to the comfort level of the person. That person, I'm assuming, has a comfort level with risk, or they wouldn't have owned the stock for so long. There's been a lot of whipsaws during that time, although it's done well for them. But they've got to be comfortable with that risk going forward, and we have to help them manage that risk. Hope that answers your question, Roseanne. Barb, will it be possible to convert traditional IRA to Roth IRA after 21? Sure. Yeah, no plans not to allow conversions for Roth, from traditional IRA to Roth IRAs. There's some talk about limiting contributions, as there have always been limits to contributions. There is a part of the plan that came out of Congress says that there could be an income limitation on Roth conversions, up to $400,000. If you earn more than $400,000, you can't do Roth conversions, but that's not said to be triggered for 10 years. So good question, but nothing that stops us from doing Roth conversions right now after 2021. And I don't see that happening. The government gets a lot of money from that. So I don't expect to see them changing that. All right, we're a little over. I apologize for that. It's just about 11 o'clock. I hope that was helpful. I know it was complex, as many of these strategies are. Next week, I didn't mention what we have on track for next week. I didn't put it in my agenda. What are we talking about next week? We're going to have the normal market update. Let me find my Tuesday calendar. We have the normal update, and then we are going to talk about housing options next week. So next week will be housing options. This is a very, and then the following week is going to be Social Security distribution options, when to collect Social Security, different methods. But next week, how to handle the question about housing. I get a lot of questions from people. Well, I've got this big house. I'm looking to downsize, maybe buy a vacation home. So we're going to talk about some really basic things about that, and some maybe ideas you may not be thinking about that. So tune in next week. We'll see you then. As always, reach out to me. I have very, very few spots on my calendar for December. I think just 2 days left. And as a reminder, we will be shut down. The office will be closed down from the the afternoon of the 23rd, coming back the first week of January. So I hope everybody has a great week. I hope that was helpful, and I hope to see you soon. Take care. Bye-bye.
Hello again. I hope you enjoyed the video, and perhaps you learned something new that can help you. If you want to schedule time for me for a no-cost, no-obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.